The Federal Reserve just delivered its fifth interest rate freeze of 2026, and, scrolling through Zillow feels identical to watching your own wallet slowly combust.
Hmm.
We are sitting in this supposed holding pattern, staring down the barrel of looming 7% mortgage rates. A freeze sounds comforting on the evening news. It operates as a temporary stay of execution for anyone trying to pull together a down payment. You refresh the real estate app, you see a modest three-bedroom house, you notice the monthly payment jump by $200 because the bond market shifted while you were eating lunch.
Inflation stubbornly rests above the central bank's 2% target. A rate hike in September is imminent. That becomes the first hike since July 2023. We are pulling apart a stack of CBS News financial reports from late July 2026 for this deep dive to map out how homebuyers survive this hostile borrowing climate before that September Fed meeting alters the math entirely. The data confirms lenders actively position themselves for a rate increase today.
That September threat makes the current situation even more painful when you quantify how much ground borrowers lost this year. Borrowers saw mortgage rates drop by a full percentage point back in 2025. Discovering that discount felt like putting on your winter coat and finding a crisp $20 bill in the pocket. Get that sudden rush of excitement. Reaching a little deeper into the pocket reveals a massive hole in the lining.
The $20 vanished. The rate drop evaporated with it. Rates march right back up toward that dreaded 7% threshold.
The discount is literally gone.
Surging oil prices and the war with Iran drive that rapid regression. These chaotic global drivers dictate the borrowing climate just as heavily as Jerome Powell's gavel. Overseas geopolitical conflicts create immediate ripples in the U.S. bond market.
Lenders react to international instability by tightening their grip on capital
and demanding higher returns for long-term loans. Investors see global energy shocks and immediately bake prolonged inflation expectations into the bond market.
You get a push notification on your phone about the conflict escalating in the Strait of Hormuz. Your first thought is the human cost. Your second thought, sitting in front of a spreadsheet with your housing budget, is a sinking feeling in your stomach. The 10-year Treasury yield is about to spike.
Higher oil prices drive up transportation and manufacturing costs globally. Sticky inflation becomes a guarantee. Bond investors demand higher yields on the 10-year Treasury to compensate for that inflation eroding their long-term returns. Mortgage lenders bundle individual home loans into mortgage-backed securities.
Those securities compete directly with those 10-year Treasuries for investor capital.
The U.S. government paying a higher yield to bondholders forces the mortgage lender to raise the interest rate on your specific home loan just to attract investors. The global energy market directly subsidizes or penalizes domestic borrowing.
Watching that yield fluctuate translates directly to watching your monthly housing budget shrink. The abstract macro data suddenly becomes the micro feeling of crossing entire neighborhoods off your target list because you're priced out again. The mechanical link between a barrel of crude oil and a 30-year fixed mortgage in Ohio dictates everything. A barrel of crude oil holds immense voting power over your future mortgage payment. We are trapped in a system where domestic housing affordability is held hostage by international crude oil logistics.
Acknowledging that global instability actively drives mortgage rates back up toward that 7% threshold forces a strategic shift for the borrower. Securing a rate lock now provides a definitive ceiling on borrowing costs ahead of the September Fed meeting. The financial reports from late July emphasize locking in a rate immediately to defend against preemptive lender hikes.
Locking in a rate right now feels totally counterintuitive. Rates are objectively terrible compared to early 2024. Committing to a high mortgage rate today equates to buying flood insurance as the water is already rising into your living room. You cap the damage. You still lock yourself into a historically bad deal. You pay a premium to stop the bleeding on a wound that is already deep.
Mortgage lenders operate with ruthless efficiency. They aggressively price the inevitability of a September hike into their offers today. Banks process the exact same inflation data and geopolitical tension driving our bond market discussion. They adjust their rates upward preemptively. Waiting for a formal announcement leaves the borrower exposed to lenders raising the cost of capital beforehand.
A 30-day or 60-day rate lock transfers the volatility risk from the borrower back to the bank.
The float-down mechanic serves as the borrower's most effective countermove in this hostile environment. You lock the rate now to build a reinforced ceiling against that probable September hike.
You sort of build a roof over your head.
The August inflation reports or unemployment data could trigger a miraculous rate drop. You simply unlock and float down to the cheaper rate before closing. You retain the option to lower your rate if the market improves.
You cap the maximum damage, while retaining the ability to capitalize on a sudden stroke of luck.
Lenders charge for that privilege. Implementing the float down requires navigating specific lender fees. Banks often demand a non-refundable upfront fee. They also build a slightly higher baseline interest rate into the initial lock to compensate for providing that option. They sell a financial derivative. It acts as a put option on the mortgage.
The borrower determines whether the cost of that option outweighs the probability of rates dropping significantly before the closing date. The float-down fee hurts. Hitting the reset button on the loan pricing feels amazing if the jobs report tanks in August and rates plummet. The float-down operates as the only mechanism respecting the sheer volatility of this market.
The defensive rate lock establishes a ceiling. Offensive maneuvers force a below-average rate out of lenders currently holding all the cards. Borrowers must abandon the traditional 30-year fixed mortgage. Alternative structures become mandatory survival tools.
Adjustable rate mortgages, 15-year terms, heavy down payment increases, and buying down the interest rate with mortgage points. Walking away from the 30-year fix feels like abandoning the bedrock of middle-class stability. You sign the paper, you know your payment for the next 3 decades, you sleep easily at night. The adjustable rate mortgage forces a trade. You swap long-term stability for immediate relief. You lock in a low introductory rate for 5 or 7 years,
You spend those years staring at the calendar.
anticipating the day the rate resets to whatever chaos the market is experiencing.
Modern ARMs operate under strict regulatory frameworks designed to prevent sudden payment shock. The initial fixed period provides a guaranteed window of affordability. Borrowers utilize this window to build equity or prepare for a refinance before the adjustment period begins. The financial tool itself is neutral. The danger lies solely in misunderstanding the terms of the adjustment caps and the underlying index.
Those adjustment caps act as the mechanical guardrails, stopping your payment from doubling overnight. A common structure is a 51 ARM with 225 caps.
You get 5 years fixed. The rate then adjusts once a year. That first 2 means the rate cannot increase by more than 2 percentage points on its very first adjustment. Market rates soaring to the moon changes nothing about that initial cap.
The second 2 caps any subsequent annual adjustment at 2%.
That 5 is the lifetime cap. Your rate can never go higher than 5 percentage points above your initial starting rate.
You still have to actively monitor the market. The fully indexed rate derives from a specific benchmark.
The secured overnight financing rate serves as that benchmark. The lender adds a margin to that SOFR figure. An SOFR sitting at 4% combined with a lender margin of 2% pushes your adjusted rate to 6%. Understanding these mechanics allows a borrower to map out the absolute worst-case scenario mathematically. You plot the maximum possible payment at year 6 and year 7.
An income trajectory or equity buildup plan failing to support that maximum cap payment turns the ARM into a toxic instrument. Choosing a 15-year term represents another aggressive play. It sounds like financial self-sabotage for the average buyer. You condense 30 years of debt into half the time.
Lenders offer significantly lower interest rates on 15-year terms. They recoup their principal faster. They assume far less duration risk.
Absorbing those massively larger monthly payments swaps a slow financial bleed for a massive immediate drain on your liquidity. The borrower suffocates their cash flow in the present for a theoretical future payoff.
A bank lending money for 30 years faces massive uncertainty regarding long-term inflation. They also face risks tied to future interest rate cycles. Cutting the repayment timeline in half strips away that uncertainty. They pass that risk reduction onto the borrower in the form of a lower initial rate.
The amortization schedule shows the real impact. In the first year of a traditional 30-year mortgage, the vast majority of your monthly payment goes directly toward interest.
You barely make a dent in the principal balance.
A 15-year term forces a much larger percentage of that higher monthly payment to attack the principal immediately.
You build home equity at an accelerated pace. You also pay significantly less total interest over the life of the loan.
The borrower absorbs a heavier blow today to eliminate hundreds of thousands of dollars in interest obligations. The strategy requires a highly stable, bulletproof monthly income. You endure a decade and a half of tight budgets to prevent the bank from capturing a massive premium on your debt. Buying mortgage points presents a totally different mechanical approach. You hand the bank cash up front at closing to physically buy down the interest rate.
You pay a percentage of the total loan amount out of pocket to secure a lower monthly payment. Purchasing mortgage points functions strictly as prepaid interest on the secondary mortgage market. A borrower typically pays 1% of the loan amount upfront to reduce the interest rate by 0.25%. This strategy dictates a rigid timeline.
The borrower must stay in the home past the break-even point to realize the actual return on that upfront cash investment.
A $400,000 loan makes the math very stark. 1 point costs $4,000 out of pocket at closing. That 0.25% rate reduction saves $100 a month on the mortgage payment.
Reaching the break-even point takes exactly 40 months. You are betting $4,000 that you will not sell the house or refinance for at least 3.5 years.
Handing over extra cash at closing strains a borrower already draining their savings for a down payment. Global conflicts swing rates overnight. Locking up liquidity in mortgage points carries massive risk. Rates dropping significantly in 2 years tempts the borrower to refinance and capture a lower market rate.
The unamortized portion of that upfront cash investment completely disappears in that refinance scenario. You literally set thousands of dollars on fire just to temporarily lower your monthly payment by a fraction. Finding a full percentage point discount just by opening a few more browser tabs exposes the inefficiency of the traditional mortgage process. People spend weeks negotiating the purchase price of a house. They agonize over a $3,000 difference.
They accept the very first mortgage rate their legacy bank offers them.
The macro data of a high national average gets beaten by the micro action of refusing to accept the first offer. You have to force them to fight for your debt.
The CBS data isolates a critical defensive action. Ruthlessly shopping around across online marketplaces consistently yields a rate 50 basis points to a full percentage point below the national average. Lenders possess wildly varying internal liquidity needs on any given day. Their risk appetites shift constantly.
One bank aggressively prices loans to balance their books. Another intentionally overprices mortgages to slow down incoming volume. Online marketplaces aggregate these offers. They force lenders to compete transparently.
Mortgage brokers and online direct lenders bypass the massive overhead costs of legacy branch networks. Major retail banks charge a premium simply because they rely on brand trust. They target captive audiences, assuming an existing checking account entitles them to the best mortgage rate.
The lenders already bake a September rate hike into today's mortgages based purely on inflation and the Iran war.
A Fed freeze functions merely as the quiet before the September storm. Borrowers executing rate locks or adopting ARMs insulate themselves against impending rate hikes. Those relying on hope will fund the bank's record profits. Passive participation in this market guarantees an expensive outcome.
Those highly anticipated August unemployment reports could reveal a completely unexpected collapse in the job market. Lenders priced strictly for inflation suddenly face a population totally unable to afford the down payments. The resulting liquidity crisis would freeze the housing sector entirely.
The cascading effects of a sudden employment crisis violently collide with preemptively inflated rates. The Federal Reserve faces contradictory mandates. They must fight sticky inflation while scrambling to rescue a plummeting labor market.
Staring at that Zillow listing takes on a whole new meaning when you stop and wonder what actually happens to the entire housing market's liquidity if that August job market collapses while rates are trapped at 7%.